Welcome to another episode of Equity Street, where we provide the roadmap to property wealth. We're answering the questions of real estate investors across the country, and of course, I am joined by one of Australia's leading property experts, Matthew Bauer, to answer your questions. So let's get straight on into it. Now, this question comes from Selma and Angelo, and they've said, how big of an impact will an interest rate rise make on my repayments?
Yeah, good question, guys. And look, this is very much a case-by-case situation or individual circumstances, as well as, I guess, looking at it from a general market sense. But look, any interest rate rise obviously needs to be given its due respect with regards to your own personal cash flow situation. But when we look at, I guess, existing owner-occupiers who perhaps had their current mortgage for an extended period of time, or perhaps refinanced 12 or 18 months ago when rates were red hot and the opportunities were there, as they still are at the moment. I think throughout COVID we've seen plenty of evidence that people have saved up their dollars, are well ahead on their repayment schedule anyway, or they've got substantial savings sitting in their offset accounts. So for those that are smart money managers and have looked at their cash flow control component throughout that period, I think they're well ahead of schedule. So and certainly well prepared to handle an interest rate rise. And I guess a similar conversation for investors as well. When you've got smart investors with the right portfolio structure in place, with the right advice, then they're always in a position to ensure that they've got plenty of cash flow buffers within their finance structure to handle the inevitable rate increase. So whilst there's been plenty of talk about 4 to 6 interest rate rises in a very quick or short space of time, it remains to see whether that's actually going to happen on that basis. But like any smart investors, we're always anticipating that at some point there will be interest rate rises, and it's about managing your cash flow to absorb that, and certainly assessing your situation to make sure you've got plenty of buffers, as I say. And look, I guess as part of that too, that the banks are always running serviceability calculations well above the standard variable rate. So yes, for those who haven't got the right advice in place or the right structures, and perhaps they've overcommitted without any buffers or contingency plans in place from the beginning, they will be the ones that may see a fairly significant impact on their position if they haven't got themselves set correctly.